Happy New Year to every one of you. Last time we spoke, we already started our discussion of banking regulation and bank regulation. I told you a little bit about the theory of bank regulation, and the regulation of systemic risk. There's a typo here. It's always something. And we had a first glance at the regulatory framework and how it evolved, especially in the European Union. And I want to concentrate on actually 4 particular topics. Today we'll be talking about leverage ratios and maybe a little bit about the MA risk, the minimum requirements on risk management. MA risk is a German abbreviation for Mindestanforderung, minimum requirements on risk management. And then obviously BAZEL 1, 2, 3, and also a little bit more theoretical deposit insurance and bank runs. That's not rules, but bank runs, another typo. It happens when you have a very large script. And so let's start with leverage ratios. Now, I told you last time that actually capital requirements and requirements on equity, regulatory capital, but also in other words on leverage, are one important aspect of any bank regulation system, of any regulatory framework. The idea is that if a bank only held enough capital, only held enough equity, and when we say capital, we always mean more or less equity. When a bank were to hold enough equity, there shouldn't be any risk to the financial system or to the institution itself. So many times we've had a financial crisis. Regulators have stepped up and reacted to the financial crisis or to these financial crises by increasing capital requirements or introducing new types of capital requirement. This obviously immediately leads to an incentive for bank managers to engage in what we call regulatory arbitrage, meaning that you're trying to beat the system by moving business from one country to another country or from one business sector to another business sector, so that you are able to circumvent these capital requirements or requirements, for example, on your leverage ratio. In Germany, we've had, and we'll see this in our discussion on BAZEL 1, 2, 3, we've had this discussion that at some point regulators accepted the fact that maybe banks have a better view of their own risk, have better risk models than just a pre-specified one by regulators and supervisors. And as a result, and in BAZEL 2, regulators and supervisors allowed banks to use their own risk model, so their own company-specific risk model, in order to calculate the equity and the risk position of the bank. And as a result of these own risk models being used, especially before the financial crisis, actually equity ratios of large banks dropped dramatically. This was intended. One has to be clear that this was more or less intended because supervisors accepted the fact that if a bank is able to show realistically that its risk position is not as high as supervisors would think, then supervisors will accept the own bank-specific risk model, and then they are not forced to keep as much equity as they would, for example, with a pre-specified risk model by supervisors. As a result, you can see here for Deutsche Bank, actually the balance sheet equity ratio dropped from 3.9% to close to 2% in 2007, before at the start of the financial crisis. However, regulatory equity ratio, not ration, the regulatory equity ratio at that point was a satisfactory 8.6%. So Deutsche Bank was in the green, everything was okay with Deutsche Bank at that point because they had regulatory equity ratio of 8.6%. Now you might wonder what's the difference between the equity ratio, the balance sheet equity ratio, and the regulatory equity ratio. Well, we'll see at the end when we discuss Basel II and Basel III that these regulatory frameworks allowed banks not only to use equity to calculate regulatory equity, but also to use and to include certain parts of debt, of their liabilities, when it comes to calculating regulatory equity ratios or regulatory capital. It's rather regulatory capital. Why? Because some parts of debt are special in the sense that they do not need to be paid back immediately in case of a bankruptcy or crisis, so that it should be considered, at least in part, to be similar to equity. And this is why usually regulatory capital ratios are higher than if you were just to look at the pure equity ratio, which in this case was 1.9%. Now, because of the high indebtedness, of the high debt and high leverage of large banks during the financial crisis and the resulting danger to the financial system as a whole, especially the regulatory framework of Basel III introduced not just capital requirements, but also a debt ratio or leverage ratio that was risk sensitive, meaning that you're looking at the one hand side, you're looking at risk positions of a bank, you're looking at the investments of a bank, and if you see that the bank has made very risky investments, then this should also drive up your capital requirements. And the leverage ratio now provides additional security with regard to model risk, and it's meant to be a lower limit, or in other words, a backstop for own fund requirements resulting from these risk-sensitive regulations. So specifically, a risk-independent equity ratio was demanded already before the financial crisis, and it is empirically, you can show empirically that banks used their own risk models in the run-up, or used used their own risk models in the run-up to a crisis to make real risk appear smaller and, to some extent at least, to cover them up. Now, this was not a big surprise because, again, the standard model that was proposed by supervisors was very conservative. And supervisors made this very unattractive to force banks to employ and develop their own risk models in order to drive down capital and capital requirements. Problem was that, I guess, they drove capital down too much, and what then resulted of the financial crisis is the famous CRR, the Capital Requirements Regulation, proposed by the European Union and Basel Committee, and now included in national law. And the CRR defines first a leverage ratio as the quotient of core capital and the sum of all risk positions. So leverage ratio is simply core capital divided by overall risk positions, in the sense that you're looking, for example, at loans granted, at risky market investments, securities that you've bought, etc. So this gives you the leverage ratios. What risk positions do you have? Balance sheet items, obviously positions in derivatives, because you can infer and incur some losses from derivatives that are being traded. Also off-balance sheet transactions, very famously discovered during the financial crisis, and also securities financing transactions, such as repo transactions that got a lot of banks in during the financial crisis into trouble. And by 2006, the European Banking Authority, the EBA, shall prepare a report on the effects and effectiveness of a debt ratio and comment on an appropriate level of the debt ratio. Let's have a closer look at these different risk positions. Balance sheet assets, stated at their carrying amount after individual value adjustments have been taken into account. Neither securities nor guarantees may be taken into account to reduce positions. Loans may not be offset against deposits, makes sense. Assets are deducted from core capital that are not included in the exposure. And why look at derivatives? Well, derivatives financial derivatives are a zero-sum game. If you lose €1, the other side, your counterparty, makes €1 in profit, and vice versa. So any engagement, any investment in a derivative contract almost always carries a loss potential, and you have to make sure that this loss potential is included in the calculation of your risk position. And the values which are set for risk positions in the leverage ratio start directly with balance sheet values, and the capital requirement arising from observance of the leverage ratio essentially depends on accounting regulations. So one danger for this is the differences in accounting regulations. If you simply were to compare IFRS and US GAAP, you will see that they have completely different rules when it comes to the accounting of especially financial derivatives, and thus total assets on the balance sheet, and also the value of some asset positions might heavily depend on the accounting rules that were used. And this might make it different, or make it difficult to compare the leverage ratios from different accounting regimes. So leverage ratio is one additional way of making sure that banks are safe, that banks do not pose a threat, or are not close to default, and do not pose a threat to the financial system. Now let's look a little bit closer at something that is quite practical and very relevant for industry practice, the MA risk, the minimum requirements on risk management, or minimum risk management requirements, Mindestanforderungen an das Risikomanagement. This used to be more or less a newsletter by German BaFin, the German Financial Supervisory Authority, and then it was later on introduced into our German Banking Act. It's now paragraph 25 of the German Banking Act, KWG, and it basically requires that any credit institution has a proper business organization. And what is meant with proper business organization is you need to have risk management, and you need to have a functioning risk management with suitable methods for risk measurement and risk management. You should have clear organizational guidelines, a clear organization in your risk management process, and you should have appropriate personnel and resources allocated to your risk management. So this is a very, very general requirement by 25 A of the German Banking Act. The idea is that you as a financial supervisor, but also as a shareholder, make management liable and make it responsible to implement a proper risk management. Before that, before this introduction, the introduction of this paragraph 25A, this would have been included in the general liability of management for its general business conduct, but now, at least for credit institutions, this is where we have the MA risk, and it applies to financial institutions. The minimum risk management requirements make management liable and force managers to implement a proper risk management. So in the general section of the MA risk, we have the establishment of the overall responsibility of management for an appropriate business organization. By the way, the MA risk are not fully included in this paragraph 25A, but if you want to have a look at all the information and all the requirements, you need to look at this Rundschreiben, which is basically a newsletter by general information by German BaFin. So first of all, in the general section, you should establish, or it establishes the overall responsibility of managers, the minimum requirements for risk management, the organization of risk management function, You need to document it. You need to allocate human and technical resources to risk management. You cannot run your risk management with simply one employee if you're a large bank. Activities in new markets as well as outsourcing. So it generally states what you need to do in risk management and what your risk management needs to look like. In the special section, besonderen Teil, we do have some more specific requirements. For example, for the internal control system, das interne Kontrollsystem, in German IKS. The internal control system is a part actually of risk management and also part of controlling and internal audit function. Internal control system basically is concerned with internal auditing and the fact that you check whether you comply with laws, whether you do enough against corruption, whether you do enough against illegal behavior in your company. And this is not really, it's part of risk management, but it's internal control system. So you are not looking for external risks, but you're looking for problems that arise internally. And this is usually internal revision, internal audit, and this is summarized by the phrase internal control system. You need a clear separation of functions. You need to make sure that the people who own the risk owners are not the same persons as the risk managers. You need to document and permanently monitor all trading, lending transactions, and you have some stricter requirements for the management of liquidity risk, for example, that you need to perform regular stress tests, and this is all included in the special section of the minimum requirements on risk management. It also asks for internal audits. Internal audit checks all activities and processes within the company, should be a risk-oriented audit planning, should be communicated to management. You should monitor correction of any defects in due time. Employees are exclusively responsible for internal auditing, direct supervisory law by the supervisory board, etc., etc. And you have three control bodies. You have the internal audit and then risk controlling, but also you have compliance, maybe even in three different departments of your company. Okay. Another core element of the general requirements for risk management and the minimum requirement is the so-called international capital adequacy. I'm not sure if it's international, I think it's internal. I have to check this. Doesn't really make sense. The internal capital adequacy assessment process. What is this? It's required for financial institutions. You need to calculate an overall risk profile. You need to determine the available risk coverage potential, that is the available risk capital. You need to formulate a business strategy, also a consistent risk strategy. You need to establish appropriate risk management and controlling processes, and then formulate a capital planning process, how you want to proceed, given the risk profile and the risk capital you have, to make sure that in the future you have enough risk capital on hand, regulatory capital, to cover all your risky positions that you've taken. Okay. Now, all considerable risks must be included in the determination of the overall risk profile. This also includes counterparty default, market risk, business participation, reputation, op risk. You have some degrees of freedom regarding the methodology when it comes to the quantification and measurement of risk. You can also use different risk models. You need to employ more stress tests. And this is all included in the MA risk, in the minimum risk management requirements. Okay. Now let's just start a little bit with BAZEL 1 and BAZEL 2 and BAZEL 3. I want to give you a short overlook of BAZEL 1, 2, 3. And I'll probably stop then and we'll continue next week because we are already quite far in the lecture and we don't need to rush things. Why BAZEL and why BAZEL 1, 2, 3? First of all, BAZEL 1, 2, 3 are called BAZEL because they were proposed by the BAZEL Committee on Banking Supervision and Regulation. The BAZEL Committee is more or less a project group, a working group at the Bank for International Settlements. The BIS, the Bank for International Settlements, is regarded to be the central bank of central banks. And one of its most important functions is to bring central bankers, financial regulators and supervisors together so that they can work together on a unified regulatory regime and regulatory framework that can be implemented around the world. And most notably, BAZEL Committee proposed frameworks for banking supervision and regulation. And the first framework was then called BAZEL 1. The second one, proposed in the mid-2000s, was BAZEL 2, and the one proposed after the financial crisis at the start of the 2010s was BAZEL 3. Some parts of BAZEL 3 that have been implemented later on are sometimes considered to form a new package, BAZEL 4, but basically this is still BAZEL 3. So we have BAZEL 1 in the 90s, BAZEL 2 in the mid-2000s, and BAZEL 3 after the great financial crisis. And they are all called BAZEL because they were proposed by the BAZEL Committee on Banking Supervision and Regulation. Now, what happened in these three frameworks is that the BAZEL Committee sat down and thought of a unified framework that could be implemented at least in the whole European Union, and this is where it's also implemented. We also have the same thing for insurance companies. BAZEL 1, 2, 3 are for banks only, more or less. We have the same for insurance companies, but for insurance companies, this is called Solvency 1 and 2. One has to be aware of the fact that BAZEL 1 is close to Solvency 1, and Solvency 2 is close to BAZEL 2 with a little bit of BAZEL 3. The insurance sector always lagged almost 10 years behind the banking system. So Solvency 2 was only implemented, or still implemented right now, and was introduced only a couple of years ago, whereas Solvency 2 was implemented and introduced only a couple of years ago. And even though it includes and resembles BAZEL 2, BAZEL 2 is much older. BAZEL 2 is from 2004, 2005. So Solvency 2 is closer to BAZEL 2, and there is almost a 10-year lag between banking and insurance sector supervision. Now, as you can see, BAZEL 1 was introduced or started in 1988, was then introduced into European law and then across the European Union. And it might be a good idea for you for next week to have a look at the slides for BAZEL 1, 2, 3. As you can see, BAZEL 1 was still very coarse. And what happened is that it only looked at certain risk types, especially lending. As you can see, we had a very coarse distinction between risk-weighted classes. You look at the assets into which all these loans, for example, would fall. And then it's very simple. You took the amount of loans granted, the percentage of risk classes times 8%. So for example, if I were a bank and I had invested 1 billion euros, we didn't have euros back then, but let's say 1 billion Deutschmarks, 1 billion Deutschmarks in simply loans to private retail customers, so no OECD countries, banks based in OECD countries, or mortgage-backed real estate loans. So we simply invested it in private retail loans. We would have a risk weight of 100%, 1 billion times 100% times 8%. So actually this would be the required capital. Very simple, 4 bins. You simply needed to look at the loans, look into which bin the loans would go. Then you would have your risk weights times the amount of credit and loans granted times 8%. The 8% actually were and are very famous. Then you need, this is the required capital. On the other side, you need to calculate the available capital, regulatory capital. And we had a distinction between tier 1 and tier 2 capital. So core capital, equity basically, and some so-called supplementary capital, Ergänzungskapital in Germany. And then this gives you the required capital. Then you calculate the available regulatory capital, and basically you were done. With Basel II, this changed. We had the CRD. It started in 2004, was introduced in 5 and 6 and later on. And actually we had 3 different pillars. Basel II was much more complicated and complex than Basel I. And first of all, it had, again, pillar 1 was minimum capital requirements. Capital 2 was the supervisory process, and pillar 3 was extended how do you say, Offenlegung in English, extended requirements on disclosure, on disclosing information on the company. So, for example, here you had the standardized approach for credit risk, Kreditstandardansatz, and the internal ratings-based approach. You didn't have a very strict rule like this, but you were actually given the option to use your own model to calculate required capital. So this was the internal ratings-based approach. In this case, supervisors had to accept and had to audit the model, but not your calculation. And then again, we had the granted loans times the risk weight times again 8%. So this actually stayed the same, and we got the required equity capital. In these tables, you can see the different risk weights for exposures to sovereigns, for receivable from companies, and they had very elaborate risk weighting schemes for all those different investments. Internal ratings-based approach, you didn't have to use external ratings, but you could do your own. You needed to calculate the PD, the probability of default, loss given default, etc. And then you could also use the standard approach. Standard approach was very conservative. So you had an incentive to come up with your own risk model. And as you can see, eligible own funds divided by risk-weighted assets plus 12.5 times attributable amounts for market risks and operational risk had to be larger than 8%. This again was the pillar 1 in Basel II, but we also had stricter requirements on the supervisory review process, on what information management had to disclose, etc. And then pillar 3. So this was Basel II. I would like to ask you to have a look at Basel 1, 2, and 3 for next week. And then we can continue with our discussion next week. And then afterwards, we'll close this section with a theoretical look at deposit insurance and bank runs. This is, of course, also part of banking regulation, but this is also the part where it gets a little bit theoretical, because the deposit insurance schemes can be included in the diamond model, which then becomes the Diamond-Dybvig model. We've already seen one of the first lectures. Okay, so thank you for your attention. I will stop now the recording.